Hello and welcome to the second chapter of the Banker's Masterclass series in association with Banking Circle on reducing the risk of bank de-risking. I'm Joy Macknight, editor of The Banker, and joining me is Mitch Trehan, who's UK Head of Compliance and Money Laundering Reporting Officer at Banking Circle. Thanks again for joining me, Mitch.
Hi Joy, thanks for having me back and welcome everyone for joining again.
So you mentioned in the previous chapter that respondents to your survey feel that they have too many correspondent banking partners. I guess the big question is, how many is too many?
Of the numbers we've seen from people that replied to our survey, 57% have said that they have 3 or 4 banking relationships, 23% only have 1 or 2, and 18% have 5 or 6. We also learned that smaller banks tend to have more relationships than non-bank financial institutions. But less than 1 in 3 of those people responding felt they had the right number of relationships. 63% felt that they had too many relationships, and only 4% people actually wanted more.
Excellent. And then how has the number of correspondent banking relationships really changed over the recent years?
For 77% of the banks and non-banks that we had surveyed, 6% had seen their relationships fall, but what we found really interesting was a geographical split. We started learning more that Southern Europe were those that were most likely to have seen an increase, and Northern Europe was most likely to have seen a decrease in recent years. 87% in Southern Europe went up, and in Northern Europe, we've seen that decrease of 14%.
So your research has really looked at where those relationships have been ending. So let's focus on that now. So which countries have been most affected? And then what have been the causes behind that?
Let's break down first the cause that actually has created de-risking. Sometimes the banks have done it, and sometimes we've seen that underlying firms have proactively taken that decision. And what we've learned is that when the banks are de-risking their underlying customers, the reason the banks give is that it was because the underlying customer no longer met the eligibility criteria. And 61% that have been de-risked have said the reason they were given by their bank is that they no longer met the bank's new eligibility criteria. And this eligibility criteria actually started coming out from banks as a result of PSD2, and banks needing to treat these customers in a proportionate, objective, and non-discriminatory manner. To achieve that, banks wrote new eligibility criteria. But what we've also seen is firms themselves decided to reduce their banking relationship. And when they did that, more than half have said that they've done it for cost reasons. So they've really analysed how they can more efficiently give their underlying customers payments and realised that for cost reasons, they actually wanted to move away from some of their banks. But again, that was just over half. So while that's the main driver, there are other reasons which we've seen to be product capability. Does their current banking providers actually give them the full suite of products that they need for their underlying customers? So taking that then to geographical bit, and some of the results we got was really, really interesting from my perspective. Southern Europe is actually most likely to have fallen victim to bank de-risking. So it looks like there's a trend and a change there from the regulators and supervisors and the pressures they're putting on firms in that region. And then in Eastern Europe, they were the ones that were most likely the firm themselves to have decided to move away from a bank and find a more efficient, more effective from a cost base and from a product perspective. But one thing that's common across everybody that's responded is that changing these number of relationships and the relationship between them and their banking providers has led to some difficulties in offering international payments, and costs overwhelmingly have risen.
Excellent. Well, thank you so much for your insights, Mitch. In Chapter 3, we'll be taking a deeper dive into how well the current system is working for banks.